Thank you very much for joining us today, Rob. Perhaps if you could just kick things off by introducing yourself and telling us a little bit more how you fit into the Dow Jones framework.
Sure. So I'm Rob Passarella. I'm Vice President and Managing Director for Institutional Markets. I cover pretty much news delivery, if you will, to human beings on a desktop as well as to machines.
So then what have been the biggest technological changes then that you've seen, say, over the last 2 years?
I'd say the biggest thing is there's a little joke that we have every once in a while in thinking about how the pace of news has changed and how we've actually gone from a more human-centric world to actually a more machine-centric world. So I always think about the Terminator movies. There's a mythical date called Judgment Date, which I think is April 21st of 2011. I think somehow, even in the real world, we might have actually hit that date in looking at machines and their use of news. For example, recently in America we had a game show called Jeopardy, where IBM Watson actually beat two returning champions, and that was pretty much done as a machine. And for me, that's a very poignant moment because actually Jeopardy is a very complex game that's built on context. So the machine was actually able to learn context and beat two human beings. So maybe the last bastion of hope for humans is context. So we'll have to figure out what to do. And I find that fascinating. So the pace of innovation, at least in machines and what they're doing and sort of problems that we thought were hard for them, is becoming much easier. So
are we saying that from a market's perspective, that machines are now able to detect news, as it were, in a way that they couldn't before?
It's a little different, but yeah, that's the vein. Really what's happened is that from a news perspective, we actually write for two audiences, and which may be a little unsettling to people, but that's really how it is. Machines and obviously deal in news in a different way. They deal more in structured type of news that we create versus human beings who have their own structure of how they read news. But it's more data, at least initially how it started, but it's becoming to a sense that they're actually starting to use context within news machines, that is.
So we're talking about your data that you're sending out, your news data will affect, say, people's algos and how they react and respond.
I think the classic way to look at it is as you progress through and actually have machines utilizing news, it really does start at data. So for the first part, it would be something like what we call an elementized news feed. We would take key bits of information and create them as data fields. So think about an employment number that gets delivered, or some type of embargoed data where in the old context, people would actually know what to do with that number. They would look and say, oh, there's an estimate out there. I know that it's come in above or below, and essentially somebody would trade off that as a human being. Machines are doing that in an automated fashion. So what we do is we field the data. It's delivered then in milliseconds to a machine that's actually co-located probably at an execution site, and then is making a transaction based on that data.
So what kind of things are you looking to put forward then in the future?
What's happening is just as human beings want to use sentiment or context, is machines want to be able to do, or at least the people who program the machines and the trading ideas would like to do the same thing. So we're seeing that type of analysis now starting to take place more heavily into the market. Usually it was on the fringes of more esoteric type firms who really wanted to go after that and had the computing power as well as the intellectual power to do that, and we're seeing it's becoming more syndicated throughout the market where they really want to get an idea of how to be able to do that for, say, a certain model, thinking about maybe a fundamental model and wanting to add some idea of sentiment into that model and taking advantage of either news flows or changes, if you will, in the type of news that's being published.
Actually, talking of sentiment, one thing that came up before we sat down, we were talking about how politics is actually a key driver when it comes to volatility in the markets, and political sentiment in particular. And so how is it that so much is changing in the marketplace as a result of politics, and what kind of things are people looking at? I think you mentioned specifically one which was quite surprising.
I think just as people gravitate to try to figure out any edge in the marketplace to get insight, and usually it begins with that. I've been joking about this in the past couple of weeks, is that I feel as almost as every time Angela Merkel comes out and she wears a different color jacket, people are trying to correlate that to her mood and maybe what she may say as a policy statement. Usually what happens in markets in times of extreme dislocation or even crisis is that fundamentals stop driving the market to a degree, and really it's the leaders who then really drive the market by statements. So some cases is depending on tenor or tone, which is easy to see for human beings, in a sense, when somebody delivers a speech. It's also the language that's used, and very, very much on point when it comes to especially political people who have their statements sort of brushed, in a sense, with the right language. Is there are patterns within that. So, for example, the past ECB president, Trichet, whenever he said vigilant, there was a certain meaning to that and a certain context that markets would interpret. A machine could pick up that language and try to backtest that across the news and see, okay, in the past when we've used words like vigilant, what has been the response from a price perspective in a market for certain things? And that's something where you can go back in time and look and measure because the data's there.
So your systems are actually able to analyze live news like that, the things that people are saying in Parliament, and actually make decisions for the markets based on that?
I would say is the systems that we have don't specifically do that. We provide the means for somebody to build that. Usually that's where the real value comes in, is being able to take that data and take the aggregate of the archives of news that we had and our coverage of which we extend. And really the intellectual capital comes from the organization on the other side who wants to do that and be able to impart that to a model. So that's the everybody in a trading strategy wants to have some advantage, and the advantage really becomes is being able to take that data, make sure it's malleable in a way you want to use it, and then bring the value that you have as a firm in trading in those opportunities.
So how are you changing your offerings, your product offerings, depending on your clients' needs and your customers' needs?
Well, in a sense, what we're doing to change our offering is really looking at the way that we cover the news and what products that we're producing. So, for example, we did something recently which for Dow Jones was, I would say, a very bold step, is we started to deliver news directly via a desktop for the FX market, which means we're going after breaking news, which you would think in a sense is some way going back to the future, if you will, is we've heard so much that news is commoditized in a lot of ways. And some of the news is, but there's so much more in a sense of what you can do from a news coverage where good old-fashioned journalism still works. Think about in the context of delivering that, a breaking story or new information that's out there, or talking to policy officials and being able to get an interview, which in certain markets is really driving the flow of what's happening. Now take that and look, in an archival sense, and making that as available for a machine to do some back testing. That makes now a whole pattern which you can actually start to take a look at and use as part of insight for trading. So really what we try to do is make it much more easy to work with the data by having tons of metadata. So if you wanted to look at the news and say, was this a policy statement, was this an interview, was this in a sense news about news, or is this some type of a regional inflection, you can actually go and do that and really refine the news to a point. That usually is what happens a lot in trading, is they want to, especially in the analytics side, they want to refine it and take the other bits out that may not be influencing and find the bits that do influence.
So how far, if not already, are we from a point where you don't actually have to specifically provide news for machines, because the machines, as you were saying, are contextually driven and simply don't need that extra crutch of being, I suppose, put into their language?
I think we're getting closer and closer as we open this up with the Judgment Day and Jeopardy and Watson. We're getting much closer, and I think the brilliant thing about that is that a lot of these tools are open sourced. So what you're seeing is that people are taking common tools that are out there and refining them by adding their intellectual capital of how they want to do, whether they're natural language processing gurus that they may hire, or certain types of computational linguistics people. But the tools are open and available, and they're bringing that in, and they're using the base of someone like Dow Jones to say, you've got such comprehensive coverage to bring that in. So they're really figuring, in a sense, the right way to do that and make that happen. But I would say machines more and more are just not needing specialized information. They're starting to take the information itself.
Well, have you ever seen Cleverbot online, which is a context-driven chat engine? But I've seen tests done where they actually ask it a question, and then there's someone on literally sitting at the other side of the desk, and the people in the test didn't know if it was the person typing or if it was Cleverbot, and they had to choose which was which. And they got it wrong.
Yeah, this is a long thing in computer science of what we call a Turing test, right? So Alan Turing had this idea of, if you can fool a human being with a machine, you pass a certain point. So there have been tons of these. I think we used to figure out in Unix there used to be a function within, and this is going to get geeky, probably Emacs, which is a Lisp processor, right? So if you think based on a Lisp language, had this kind of psychiatrist in it where you could ask it a question, and really it was cleverly constructed to ask you your question back to you to answer you, and you felt like you were having a chat, right? So there's been a long history of this where you're trying to not fool a human being, but you're trying to make a human being, I would say, more sympathetic to the fact is that, wait, is this really a machine or not, or is this a human being? And I think we're in some cases close, and in other cases not so close, right?
Yeah.
But that's the beauty of it, is that this form and function of trying to do that, or having people want to do that, is really making it exciting, within the space of markets, because there's so much information to process. I think if you can augment human beings with machines, you get a very nice mix, right? Humans still, are idea creators, right? The machines haven't replaced that yet, right? And that's where they're gravitating to. So if somebody looks at a data set and is able to come up with an idea of how to approach that, we're now making it much easier to handle massive amounts of data for one person or a group of people to come up with something.
So we're not that far from a situation where actually the algos and the strategies will be designed by the machines, and perhaps even just given the tick by the trader in question.
I think it's a little bit more, I would say, involved than that. I don't think you ever get there. I mean, we have autopilots in planes, right? But nobody flying that plane feels happy to know, right, that I would say that in a case of emergency, right, that you don't have a pilot. And I think that's a large context in markets is the same thing, is that we're getting to a point is the machines may do some, but they're not the final decision about risk or arbitration about what they want to do. Human beings are still, and also creating that, the logic to do that is, and once again, the idea generation is a wonderful human endeavor, right? That's still the creative part of this. The machine is doing more and more of the rote sort of, which machines are very good at. They don't get bored, right? Human beings get bored and try to find another outlet. So the creativity part, I think, is where we're gravitating to, and we've been doing this for years. I mean, this has gone on forever, just in markets. It's a normal creative cycle that we've seen in markets. And for example, I always think about human beings in markets, right? We used to have people on trading floors, physically trading. We don't do that anymore. But proximity was a key. You had to be close to a trading venue. Now we're doing the same with machines. Machines want to be closer and closer, and they're just proxies for humans, right? So somewhere on the other end, there's a human being who's figuring out how to program and do all these things to do what used to be a human function.
So we've been talking about the sort of the bigger long-term futurology picture. If we can maybe bring it slightly closer to home, and what developments do you expect to see over the next, say, 12 months, 24 months?
It's always hard to predict the future. We were joking about the Terminator movies, and in Judgment Day, I think they had to change it about 3 or 4 times, given the necessity of wanting to make money in films, right? To put a new serial out or new sequel. So I'd say it's always hard to forecast, but I would say more and more you will see sort of the next bastion, right? We've probably done everything we can on price data and historical, and I mean, except for going back maybe really far back and trying to line up that data. So I would say the next bastion is probably the things that are the hardest problems, which are language, right? Language-based problems. So that's where you'll see people try to figure out is creating multi-factor models that have fundamental pieces in that, but wanting to bring in language to say, well, if I've noticed in the past that certain types of things may happen and certain words are used, or certain sentiment may cause an inflection point, and that may be a good point for this type of model. All right, so I think you'll see more and more of wanting to get not only news, but social media, which is the thing, which is basically a proxy in certain veins for sentiment and other things. So it's becoming vast, where it's not just news, but what's around news, or pre-news, or even post-news, in a sense. You see a lot of, especially in social media like Twitter or stock twits, where people are talking about the news, right, and how that's driving markets. And you'll find a common theme in a sense that certain stories have unbelievable velocity of getting through markets, which means they're actually influencing. So that, I find, is sort of watching not only just news and information, but what happens to that news and information, how it does ultimately now affect the markets. So
if we're talking about a situation where sort of almost PR, if you will, is driving volatility in the markets rather than necessarily just the news itself, well, rather the fact of what the news is about. if we're talking almost about the spin of what's behind, rather than the thing itself, have we? Let's take the Eurozone and the crisis there. Have we sort of hit the peak of what the volatility is likely to be in the marketplace, or is it actually going to get worse?
From a point of view, I would say this is something when you can look. I don't know if we remembered some of the historical parallels, say in other times, right? So clearly, the late 20s, 30s, to early 40s before the war, the volatility and the changes that happened in markets, were absolutely incredible. Right, just on the massive scale that it happens. So sometimes we don't think about how that's done, right? I think historically human beings have this thing where they think history is only about 10 years before they're born, right? That's the common history, and markets have a way of forgetting, in a sense. So I would say when it comes to Eurozone or other things of volatility, it remains to be seen. I don't think we've seen anything yet because it's still playing out, right? So from a news perspective or a machine perspective, trying to gauge that by the types of stories and how that affects. I mean, clearly there are other participants in the conversation and that's why I like to bring up. You called it PR. I would say it's almost a social influence or social intelligence that's out there. When you see this morning, I think there was a very interesting headline that we had that. I think it was the Greek Prime Minister basically saying today is that he believes things are fine. Right, which the reaction I saw not only from journalists, right, on that statement via Twitter, right, our own journalist at Dow Jones, but other market participants in there was almost to the point of fun sarcasm, which is, oh, it's fine, you're kidding me, right? When did you realize that today it's fine, right? Did someone call you up? So I think that's funny, is that you're seeing immediate reaction now that would take a lot longer to do because of that, and it's a wonderful interplay between the established, I would say, or more heritage-type media and the new media. In some cases, they're blending.
So, high-frequency trading, obviously it's one of those things that people tend to use as a demonizer and say it's causing all the problems in the markets, it's all down to these evil high-frequency traders. And actually, from what I've been told, it makes up a very small fragment of actually what goes on in the markets. So does it really contribute to volatility in the way it's advertised?
I don't know for sure. I think it definitely has an impact because of the way the machines work and the way high-frequency trading works and what they're trying to do in establishing markets. You sort of, to a degree, get to the answer quicker, right? So when you have a dislocation, you do get those type of price momentum that shifts, right? And you're getting to what would be the answer anyway a lot quicker because of the speed. It's no different, though, historically, right? Historically, we've seen plenty of movements and panics in markets and how quickly prices can change when there are no basically takers on the other side, right? That happens in markets all the time, in certain things. I mean, clearly it's been a little bit more exacerbated because of some of the changes that have gone on in markets between best bid, best offer, decimalization, Reg NMS, especially in the equity markets, where we've changed the paradigm of how markets actually work to a degree for the betterment of the investor, and yet it's caused, in a sense, some interesting problems that happen that you never had before. Right? In the old terms of equity markets, specialists would come in and maintain price stability to some degree. In fact, in the flash crash specifically, right, and that's kind of the big bugaboo about high frequency, usually as everybody comes.
Yeah.
If you look at that dislocation, is the rules between the different venues, right, and some of the fragmentation that was there, really caused, for the most part, people to say, I'm not exactly sure what's happening. I provide liquidity, but you know what, it's via machine. I need to shut that off. So the human beings made conscious decisions to shut that off, which meant less liquidity. So I think sometimes we do things in markets and they have unintended consequences that cause us to believe that we've really mucked everything up on that side for what's happened. But I would say is we've had volatility before. It's a little bit slower when, yes, it was human to human, but when it comes to high frequency, in that case, it's always a huge bugbear that's out there. But I would say it just gets you to an answer quicker, right? Is if you're watching equities fall in some cases and in price action, it probably means there's something wrong, especially with that company or that industry. I mean, we've seen it with the banks lately. It's not like there isn't a problem, but you get there quicker.
So for those that do play the latency game and are just trying to go for the fastest speed possible, do you think we're far from getting to a point where there'll just be a stalemate in terms of speed, where the differences are so slight that actually there's no real difference at all?
I think you get that in certain markets. I mean, clearly that's happened to a degree in what goes on in Chicago, especially with the E-mini, right? That's a typical trade that happens that off of certain U.S. government numbers that are out there, you'll see that as being the price activity at 8:30, right, in 1 millisecond. You'll see that activity that goes in. But I always feel that there's a certain sense of tiering in the marketplace, which is the guys at the high frequency end in trading at the millisecond are all competing against each other, and there are definite wins and losses at that level. But there's a second and third move that happens that they don't participate in, where the rest of the market comes in. So I almost think of that in a lot of senses pro sports. You know, I don't know if you play football or soccer, as we call it in America, but there's the weekend warrior who has, in a beer league, who has fun and that's enjoyable. There's the semi-pro guy who wants to be pro, but he may never make it and he gets paid for it at certain levels. And then there's the professional athlete. Well, it's the same thing in markets. There's competition at different levels depending on which price action or which ways the transaction goes across the time scale. And there's still participation. I mean, there's still people who have no need for high frequency and trade on a longer basis because of fundamentals of price action and where value is.
I know from a lot of the conversations I've had with people that there's fear over fragmentation and what may happen as the markets do break up into smaller trading venues and the like. But I would have thought for a news delivery service such as Dow Jones, that's probably rather good.
I would say in one respect, it'll make it difficult for markets as venues start to come up and you try to figure out there's always primary venues, there are always established venues that people like. But clearly, if we're into fragmentation, there are opportunities because of that, because markets in some cases would then have either via latency or other ways, there would be arbitrage between markets. And that's usually the key where trading opportunities actually develop again, right? So we see it today in certain OTC type markets that are not exchanges. There is fragmentation and there are latency curves. So that's really where news information starts to enter in. For example, dealer-based networks, where you have one participant that is connected to multiple broker-type networks. There are certain firms out there that are looking at the latency trails on either one of these networks and trying to figure out, way back as we did with in equities when we went electronic, like the NASDAQ in some cases, that some people update bids faster or quotes faster than others. And some are slower. So that is a point of view that happens in markets where we start to take those arbs and we work on them and actually try to get rid of those arbs via price competition. And taking advantage of the profit that's out there because of those arbitrages. So I would say that's, if we do have that type of fragmentation, it will cause interesting opportunities out there and probably, to some degree, allow firms to want to compete again in trading. We've seen, I guess, maybe because of the way high frequency and some of the markets have gone, we've seen that step off. But there's always a rebirth and renaissance that happens whenever you have one change in the marketplace. Somebody tries to figure out how to go after it. So it could be en masse if we have some fragmentation that goes on because of the markets.
Indeed. Well, it'll be interesting to see where that goes. Thank you very much for speaking with us today, but we are unfortunately out of time. I look very much forward to seeing you at TradeTech, and so if you would like more information on that, and I suppose to hear more from Rob, you can visit www.tradetecheurope.com, and of course feel free to mention where they can find out more about what you do.
Sure, you can actually go to www.dowjones.com.
Brilliant, thank you very much.
Thank you.